All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest with us, Jonathan DeYoe. And he is the founder and CEO of Mindful Money, which is a tool for planning to help people make practical financial decisions. John started out as a financial advisor as well in 1996, and he's got a lot of years of experience starting his own wealth management practice. He's invested in real estate as well, so we want to hear about that. And he's got a book called Mindful Money as well on Amazon. So we want to hear what are some of the lessons that he talks about for everyday people in his book, and how we can apply it to our lives through and to achieve that through whether it's real estate investing or planning, for diversification. So definitely excited to have you on here, Jonathan, and thanks for coming on.
Absolutely. I'm glad to be here and have the conversation with you, Anthony.
Great. So talk to us about your journey on Wall Street and, kind of how it all started and what you're working on now.
So a bit of the origin story. So actually, I grew up in a family that didn't have a lot of means. And so early on in my life, I was like, okay, I got to figure out how this money thing works, because I need to not be in this position and be worried about it all the time. And by the way, just we can skip right to the end of this one part is even if you end up having money, you still worry about it all the time. You don't get to not worry about it. But I did want to early on, I wanted to develop the ability to create wealth for my family. And because of that, I studied a lot about investing and a lot about real estate. My dad had a library of investing in real estate books and flipping and then buying and then doing some work on it, building up the value, borrowing against it, buying the next one. I read 50 of those books by the time I was in college, which means when I went to college, my finance degree bored me to tears. So very quickly in studying finance, I switched and I became a philosophy studies major with a religion minor. I went to seminary to become a Lutheran minister. I shifted from the path of Lutheran ministry to studying specifically Tibetan Buddhist phenomenology, became a Buddhist academic. And then my wife at the time said, hey, it's my turn to go to school, so you need to get a job. So I dropped out. Didn't finish a degree in Buddhism. Even if I had finished the degree in Buddhism, there's not a lot of jobs for that. So I went back to what I knew in finance, and I turned into a financial advisor. So, the full arc is seminarian, Buddhist academic, financial advisor. And so now I've been a financial advisor and for 25 years, and a meditator for 25, 26 years. And those two things actually really came together they came together in the Great Recession in 2008, 2009. So that's sort of the arc. And that's when I started writing the book. That's when a lot of this stuff, that's when Mindful Money is born.
Excellent. No, that's very, very interesting story. There's not every person can say that was their trajectory. And then they, pivoted. So when you made that pivot, so you wanted to get back into finance. So talk to us about how did you get back into the industry? Obviously, as an advisory role, how did you know that's what you wanted to do, and kind of how did that lead you to where you are 25 years later at this point?
So that the reality was leaving the Buddhist studies program and getting a job. That was purely, what do I know? What could I do that would be a job? And I could make some money to support my wife and I. That's really all it was. And so I did that. And at that time, Morgan Stanley, Dean Witter, Morgan Stanley, I was at 7 firms in about 6 years. So it just was, merger, acquisition, I moved, another merger, another acquisition, I moved again. It was crazy. And so in that whole process, I was a salesman. For the first 5, 6, 7 years of my financial advisory career, I was a salesman, glorified salesman. But, I ended up shifting when I left and started my own firm. I said, okay, to my clients that came with me. I had asked 6 clients to come with me, 6 really good friends. I really, really liked working with them. They weren't, always looking for the next trade. They weren't always sort of aggressive trader kind of folks. I asked them what they wanted. And they said, hey, how about more education and more financial planning? And so I built the firm starting in 2001. So 20 some years ago, I built a firm based on educating my clients and doing deep financial planning, which, starts with understanding their origin stories, understanding what they want out of life, and trying to figure out how do we move the pieces into place so that they get what they want out of life. And that whole planning dynamic just was non-existent in the Wall Street firms. So it was just literally, who can I sell a stock to? Who can I sell a bond to? And now it's totally different. Now it's, the investments are appropriate to the plan. Whatever the plan is, that's how we invest.
Sure. And let's talk about the planning aspect a little bit more. So are you primarily working with families, or are they, one-off individuals, or are they pension funds? They trust, like, who is your archetype client that you work with? Love to hear it.
Yeah. So there's three subsets. The vast majority of our clients up until the beginning of 2020 were just, couples, families, or, multi-generational families. And so we work with a lot of those kinds of people. And we have probably 300 families that we do work for. And I've got a team of 8 that do a lot in the office to support this whole process and directly serve those clients. But starting in early 2020, we started building digital courses, and we also have a digital advisor. So there's the 3 people we serve today are primarily still those families that we work with. And then the second tier is folks that aren't really ready for an advisor, or they don't want an advisor. And so we have digital tools to support them, both planning tools, and we have investing tools. We have a digital advisor partnership with Betterment that's just fantastic. And then the third group is we built these courses. So, the couple different places in my life, when I'm dealing with a transfer of family assets across generations, or when I'm talking to somebody who's never invested before, it becomes glaringly obvious that the one thing that's missing, there's probably many things, but one really big thing that's missing in our educational program is something about finance. We teach nothing of value in terms of personal finance to kids, to high school students, to college students. And so people come out with these fears and these bizarre concerns, and they get bent out of shape about what's going on in media and how that might affect them. And it's unfortunate, because we do our entire culture a disservice by not educating about personal finance. So we built these courses. We offer these courses for free in my neighborhood. We offer them to groups. There's been groups of startup incubators that have given our courses to their students. There's been teachers and faculty at different schools have given our classes to their teachers and faculty. There's been a lot of Special Olympics athletes have taken our courses. There's a lot of folks taking the courses, just getting some basic financial literacy in place.
That's great, and it's amazing to give back in that way and serve all different communities. And you'd be surprised how many people know very little about financial literacy, and it's good for you to step in. So how does, getting back to, you mentioned the real estate, and obviously that's what we talk about on the show.
Yeah.
How does the real estate investing factor into your clients' portfolios? Is it, and from maybe an allocation standpoint, on if you're looking at an average basis, is it 10%, 20%, or how would you advise your clients to invest into real estate, in a passive capacity? Because I'm sure that's how most of them would invest, under your guidance as well.
It's actually a great question, and I would say that there's a value in being active. Passive is great. I mean, there's no problem with passive, but if you think about the vast majority of what we invest in are publicly traded companies. And when you invest in a publicly traded company, you're investing in a couple different things. You're investing in the idea that this company is going to produce a product that gets sold and creates a profit. You also, as a shareholder, you have a claim on the assets, which includes the building, the real estate, the land, all that kind of stuff. So you're actually a passive real estate investor just by investing in the U.S. equity market. So oftentimes, one of the things I'm talking to people a lot about is the way you build wealth is through ownership, right? If you lend money to somebody, especially today, the rate of return you're going to get on that loan is very, very small, and you're not going to have a ton of upside. If you own your own business, you decide to be a painting contractor, or you decide to become a financial advisor, or start to consolidate a bunch of investors to buy a building together. If you own that business, there's huge upside. If you then, as you as the owner, there's more upside than the investors who are investing in that passively, right? So there's definitely a reason to be active. And you know how it is if you invest in real estate, that is a business. Like that is, there's cash flow in, there's cash flow out, there's debt, there's things break, you got to fix stuff, you got to hire people to fix stuff. It's a business in and of itself. So sometimes it's good to take a little bit less return, still be an owner, take a little bit less return, let somebody else manage all that. I think that's the passive approach. Most of the stuff that we do that's in real estate with folks specifically is we're advising on active real estate. We don't usually put like a 5% piece of the portfolio into real estate because of the overlap between real estate and US equity markets. Because if you buy those equities, you have a stake in that company's property and land and all that already. So that's built into the value. But you can add a lot of elbow grease value by owning directly a piece of real estate or in a small partnership.
Right. No, exactly. And so even from a public equities standpoint, for maybe it's a real estate investment trust, are you looking at for your clients the dividends that it pays, more so as the fluctuations in the stock price? Because as you know, real estate is very cash flow focused, at least it should be. So what are your thoughts on that?
Yeah, one of the reasons I actually really like real estate is because of, so we are value investors to begin with. So the things that we're investing in is we're investing. So we're broadly diversified. We own lots of different stuff. But our bent, our tilt, the thing that we favor is value. And what that means is it's not Tesla, Amazon, Microsoft. We own those, but we are underweighted to those relative to things that are, you're buying a certain amount of earnings for the lowest price you can, or you're buying a certain amount of dividends for the lowest price you can, or you're buying a certain amount of book value for the lowest price you can. So that's the function of investing is you're not trying to buy something and get out of it in 6 months. We're not trading, we're investing. Investing is a lifetime process. So we're trying to build, to your point, we're trying to build an income stream. And that income stream, rising dividends, rising rents, rising lease rates. These are beautiful things to invest in. They're not as sexy as Amazon or Microsoft or these, the big high-tech Tesla, the big high Bitcoin. They're not as sexy as those things, but they are more predictable, long-term, more stable. They're just fantastic investments when you're thinking about, I'd like to have a return for myself and my family for the next 50, 100 years. These are the things you want to own for those sorts of things.
Right. So how do you, and I'm going to bring up the GameStop. How do you, because there's a lot of that, like you mentioned on the media where, obviously that was, a large short position by individual and investors. And, how do you, and you mentioned Bitcoin too, and these are, besides the GameStop, Bitcoin is really an intangible asset. There's no intrinsic value behind it. It's all speculation and, it gets hyped up. So you mentioned that someone who's looking at real estate investments, it's a cyclical game, but it's not as, fluctuating as that, like GameStop situation and Bitcoin and other highly cyclical stocks. So what do you tell your clients on, kind of those types of risk profiles versus the real estate, basically what you just said?
So, those things are fun. They're interesting to watch, but the GameStop, it's just the largest, most recent example of market idiocy that we have in front of us. So that happens all the time. the idea that it was somehow a moral story about David and Goliath, that's a media narrative. That's largely bunk. Okay. There were some people that were short. They were hedge fund kind of people, or private equity kind of people. Some of those guys got squeezed horribly when a bunch of Redditors came in and bought and pushed the price up. But the biggest winners were also institutional investors. They were, Fidelity and BlackRock and a bunch of other hedge funds made a killing on the spike in the stock going up. And the people that actually drove the stock up, the original purchases, those guys made a killing. Everyone else that got in after the fact, they got their asses handed to them. They got destroyed in this trade. And so this is the thing about this is when you are an investor, when you're thinking about buying something that's going to provide an income 20 years from now, you can ignore that kind of crap. You can ignore this. I mean, Bitcoin is 16 years old, all in. And in 2017, it hit the point where, I guess 2017, it hit 20,000 and then dropped back to 3,000. And then now it's back to 30 something thousand. I mean, it's to say that there is some sort of consistent, reliable way to measure the value of Bitcoin, or that GameStop was worth anything close to what people were paying for it, is just to not understanding, cash flow, not understanding what investing is. And it's also, who was it said it? Somebody said, "Not my circus, not my monkeys." It's just like, we don't have to play that game. In fact, real wealth is often built not playing that game. And I'm in the real wealth game, not in the, sexy, cool, fast game. I'm gonna let's build wealth for generations game. And that's a different game.
Right. Can you talk a little bit about your book and how that kind of, like, for example, there's a networking app, and I'm not going to knock them, but maybe I will. Shaper. If you've ever heard of that, it's basically Swipe, and it's a business networking app. And it used to be good about 1.5 years, 2 years ago. And I used to network with all sorts of professionals in different industries. Every single person happens to be a Bitcoin expert now, and Forex commodity. Everybody seems to be an expert with those speculative endeavors. So talk to us about your book and how you can kind of steer people away from that, because a lot of these people don't understand what they're getting involved with. And just like you said, the individuals who saw what was happening with the GameStop situation, I knew that was going to go back down. I mean, people, that are educated knew that it was just a matter of time for that to just go back down. So how do you, and maybe your book talks about this kind of shift the narrative from building wealth over the speculative investments. So I'd love to hear some of your book highlights.
Yeah, so I wouldn't say the book is entirely about that. So that I in all of my talks and everything that I do, I'm constantly talking about investing versus speculating, and I think it was Graham that wrote the definition of investing, and the definition of investing is something that has a high probability outcome of continued increasing cash flows and a low probability outcome of total utter loss of capital. Like it's investing is not something that we complete in a 6-month period or a 1-year period. Speculation, the whole point is sort of, I'm going to buy something today, somebody else is going to pay more for it tomorrow. I really don't care what it does. And this is what Bitcoin is. Like there's a potential long-term store of value play for Bitcoin. It's not big enough for me to engage in, and to get excited about. So in the book, there's 3 sections in the book. The first entire section of the book deals with what I'll call the illusions. And the illusions, I say there's 8 of them. We probably won't go through all 8. But the illusions are the things that our brains tell us, or that Wall Street tells us, or the media tells us, are the things we should be paying attention to because they will help us make better decisions. And if you think about what we've gone through in the last couple of years, we've entered a pandemic. Markets had the response to the pandemic was markets had the fastest, 33% decline, 34% decline in history, followed by the fastest 100-day return to the peak in history. So what do we make of that, right? So this concept of, in a moment, we don't know what the future holds. The market is a discount mechanism. It's looking at, wow, what's going to come? What are the earnings that are come down the pipe in the future? And it's discounting those earnings. The further out those earnings are, the greater the discount. And so in a moment in March of 2020, when the markets collapsed, markets were saying, we don't know what the future earnings are going to look like. And so we're going to steer clear, and markets collapse very, very quickly. But then you start getting information about, wow, you can still get pickup in restaurants. You can still go to the hardware store and get, stuff delivered. Got a buddy who owns a retail game store, sells board games and card games and D&D and these kind of books and games. And he would do deliveries, and he'd take, pick up on the curbside pickup kind of stuff. So I knew he was going to make it. There's a lot of people that didn't make it, but many, many, many of us actually got more income, right? Because then the Fed stepped in, then the US government stepped in, and we saw incomes go through the roof. And we have more savings from last year than we've ever seen. And now we're asking, Biden is saying we're going to do another stimulus round. I just hope it's more targeted. So the reality is you can't tell. The market discounts, and that's why the market collapses quickly and then goes, wait a second, if I own this company today, I'm going to get their earnings for 20 years. And this is going to be over in a year, 18 months, over-ish in a year, 18 months. There's no reason to panic here. There's no reason to get, really been out of shape, which is why the market recovered so quickly. And then what happened? Well, then we had an election, and the election, drove everyone, whichever side of the aisle you were on, you thought that if the other side won, that was the end of the economy as we knew it. And I see that every election. And this was a very contentious election. It was very vocal, very loud, very obnoxious on both sides, one side especially. It was nutty, but markets again, they're looking 20 years in the future. They're not thinking about what's happening this week, this month, this year. They're looking forward. So the entire first section of the book is designed to sort of debunk the myths, the things that we think matter and don't to long-term investors. The middle section of the book, and one of those issues is that speculation versus investing. That's actually an entire chapter in the book, is we talk about speculation versus investing. The middle section of the book is, there's thousands of years of research, literally thousands of years of research on what makes human life worth living, what gives us greater well-being, what creates happiness. And so we kind of look at some of the more modern psychological studies. We look at some of what the philosophers have said and what some of the religious studies folks have said. Because remember, that's a big chunk of my background. And the idea is, if we understand what actually makes us happy, we're in a better position to build our plan, our financial plan, on top of something that might actually prove to be life enhancing, rather than day trading or whatever thing that we're worried about or think about might be. And the third section of the book is literally, you start the first chapter in the third section, and by the end of that section, you actually have a written financial plan. Like you don't need an advisor, you don't need a planner. You can actually just do it inside of a book. And we did that because the vast majority of people don't have financial planners, but they need some kind of process of financial planning, and I think it's critical.
Excellent. How can people find your book, Jonathan?
Book is, hopefully you can go to a local bookstore, keep them in business. If you can't find a local bookstore, Amazon obviously is, you can always find everything there.
That's for sure. And how can people find you and learn to connect with you?
The website's mindful.money. There's no .com, it's mindful.money. And you can find all of our services there. You can find all of our social media there. You can actually subscribe to our weekly commentary there. And we have a free course we offer to folks. They want to sign up for it. If they want to reference you in the notes, that's great. It's a free course on, establishing your values. It looks at your purpose, your meaningful purpose, and create a vision for your life, and then set some goals. We got a free course that supports people in that.
Awesome. Well, I look forward to checking it out myself. And for my audience, you heard it straight from Jonathan's mouth. So definitely check out his platform. And what we'll do is, in the show notes, we'll provide links to his website as well as his social media, so you can connect with him directly. And if you liked what you heard and or saw, please feel free to give us a review on iTunes, a rating and review. It helps Jonathan and my message reach a larger audience. That's just the way iTunes works. So we'd appreciate that. And just want to thank you again, Jonathan, for coming on the show today, and hope to have you on again soon.
All right. Thanks, Anthony. It was a pleasure.
Thank you.